Let me start with the truth most people never expect to hear. If I woke up tomorrow with every dollar gone, every share vanished, every investment reset to zero, I would not pick stocks. I would not hunt for the next great business or spend my days buried in annual reports calculating intrinsic value. I would do something far simpler. I would buy 3 ETFs, and then I would let the quiet, patient miracle of compounding do the rest. Now I know what you're thinking. The Oracle of Omaha built a career on reading 500 pages a day, studying competitive advantages, and finding wonderful businesses at fair prices. Why would he abandon the very thing he spent a lifetime perfecting? And that is exactly the part people misunderstand about me. What I do is not what I recommend for the people I love. In fact, it is not even what I have arranged for my own family after I am gone. My instructions are simple. 90% of my wife's inheritance goes into a low-cost S&P 500 index fund, 10% into short-term government bonds, not Berkshire stock, not a carefully selected basket of blue chips, a plain index fund. If that is what I trust for the people closest to my heart, perhaps it tells you something about what truly works. So today I want to lay it out plainly. If I had to rebuild my wealth from scratch in 2026, no reputation, no capital, no head start, these are the 3 ETFs I would buy. More importantly, I want to show you the mathematics of compounding that most people never truly understand until life has already passed them by. Before we talk about ETFs, let me take you back to the moment when everything I know about investing began forming itself. The year was 1942. I was 11 years old. I had saved $114.75 delivering newspapers, selling golf balls, and doing whatever a determined kid could find to do. Together with my sister, we bought 3 shares of Citi Service Preferred at $38.25 per share. Almost immediately, the stock dropped to $27. At 11 years old, I watched nearly a third of our money disappear. Fear is not an abstract concept when you are a child watching hard-earned savings evaporate. Eventually, the stock climbed back to $40 and I sold. I breathed the biggest sigh of relief of my life. And then I watched the stock continue climbing to $200. That one decision cost me around $480 in missed gains. An enormous sum for a child, but a lesson worth far more. Patience pays. Staying invested pays. Trying to time the market is a fool's game. A few years later, that same boy bought his first real investment, a 40-acre farm in Nebraska for $200. I did not know a thing about farming, but I understood one simple idea. Buy good assets at fair prices and let time work its magic. That farm has been in my family for over 80 years, producing income year after year regardless of what the stock market does. I tell you these stories for one reason. The principles have not changed. Human nature has not changed. The mathematics of compounding have not changed. What has changed is your access to tools that did not exist when I was getting started. Tools that make building wealth simpler, more reliable, and more accessible than at any point in human history. And the greatest of these tools is the ETF. If you are not fully clear on what an ETF is, let me put it in the simplest possible terms. An ETF, an exchange-traded fund, is a basket of stocks that trades like a single stock. One share of a well-chosen ETF can give you exposure to dozens, hundreds, or even thousands of companies simultaneously. Instant diversification, achieved in a single trade, without you needing to understand the competitive dynamics of each individual business. Instead of betting on one company succeeding, you are betting on the American economy continuing to grow. And that has historically been about as safe a bet as exists in finance. ETFs are cheap. They do not rely on expensive managers who are, based on the historical evidence, very unlikely to beat the market consistently. Some carry expense ratios as low as 0.03%. That means for every $10,000 you invest, you pay $3 per year in fees. Compare that to a typical actively managed mutual fund charging 1 to 2% annually, which can cost you hundreds of thousands, sometimes millions, over a lifetime. The difference is not academic. It is life-changing. I have said this for decades. For the vast majority of people, the best investment move you can make is to buy a low-cost index fund and hold it. Now, is that hypocritical coming from someone who picks individual stocks? Perhaps on the surface. But consider what I actually know about this game after 75 years of playing it seriously. Even professionals with Harvard MBAs, massive research teams, direct access to corporate management, and the most sophisticated analytical models money can build cannot consistently beat the index after fees. Over the past 15 years, more than 90% of actively managed large-cap funds underperformed the S&P 500. 90%. If the professionals with every conceivable advantage cannot reliably do it, why would you assume you can do it in your spare time? Why would I assume I could if I were starting from nothing today? I would not. I would take the simple road. The road that works, the road that frees you to live your actual life, instead of obsessing over stock charts and quarterly earnings calls. That brings us to the 3 ETFs I would buy if I were rebuilding from scratch today. The first is VOO, Vanguard's S&P 500 ETF. This single fund gives you ownership in the 500 largest, most profitable, most resilient companies in America. Apple, Microsoft, Amazon, Alphabet, and yes, Berkshire Hathaway, along with hundreds more. Vanguard currently charges an expense ratio of 0.03% on VOO, $3 per 10,000 invested. For that price, you get exposure to companies representing roughly 80% of the entire U.S. stock market's total value. These are businesses that produce genuine profits year after year, survive recessions, adapt to technological disruption, and consistently find ways to grow earnings. The index rebalances automatically, removing companies that fall out of the top tier and adding stronger ones, without you making a single decision. Over the past 50 years, the S&P 500 has returned approximately 10 to 10.5% annually on average, some years up 30%, some years down 20%. But the average holds, and 10% compounding annually, sustained for decades, is enough to transform modest, regular savings into wealth that changes families. The second ETF is SCHD, the Schwab U.S. Dividend Equity ETF. While VOO gives you broad market exposure, SCHD gives you specifically quality. The fund screens for U.S. companies with at least 10 consecutive years of dividend payment history, strong free cash flow relative to debt, attractive dividend yields, and consistent growth in those dividends. The roughly 100 companies that pass those screens tend to be durable, well-managed businesses, names like Chevron, Texas Instruments, Lockheed Martin, and Merck. Companies that survive downturns because their underlying economics are genuinely strong, not just fashionable. SCHD currently yields approximately 3.5 to 3.7% in dividend income annually. A $10,000 investment deposits roughly $360 to $370 per year directly into your account. And that income grows over time as the underlying companies consistently increase their payouts. The expense ratio is 0.06%. When you reinvest those dividends, particularly inside a tax-advantaged account like a Roth IRA, you create a compounding snowball of owned shares that becomes almost impossible to stop over decades. SCHD's 10-year annualized return, including dividends reinvested, is approximately 11%. It is not the most exciting fund on this list. But the most durable wealth is rarely built by chasing excitement. The third ETF is QQQ, the Invesco NASDAQ 100 ETF. This is your exposure to innovation, technology, and growth. The companies shaping the next generation of how the world works. Apple, Microsoft, Amazon, Nvidia, Meta, Alphabet, and Tesla among the top holdings. The expense ratio is 0.20%, higher than the other two, but still significantly below what most active managers charge, and the long-term performance record makes it competitive. QQQ is more volatile than VOO or SCHD. During the dot-com crash from March 2000 to October 2002, the Nasdaq fell more than 80%. $100,000 became roughly $17,000. Most investors panicked. most sold. But here is what the data shows about those who refused to panic and simply held, even buying at the absolute worst possible moment, the peak of the most overvalued technology bubble in history. And holding through all of that pain, your annualized return from 2000 to today would be approximately 14% per year. If you had continued buying through the crash, averaging down your cost, you might have achieved 18 or 19% annually. That is the power of refusing to time the market. Over the past 10 years, QQQ has delivered an annualized return of approximately 18.3%. Technology companies justify higher valuations because they earn higher returns on the capital they invest. A business that can reinvest $1 billion at 30% returns is fundamentally worth more than one reinvesting at 10%, even if you pay more upfront. Network effects, scale advantages, and durable technological moats allow these companies to compound capital at rates that most industries cannot approach. That is what QQQ gives you: concentrated exposure to the future. Together, these three ETFs cover almost everything an investor needs. VOO provides the broad foundation: stability, diversification, and the full breadth of American economic growth. SCHD provides income, defensiveness, and quality screening that holds value better during market downturns. QQQ provides the growth engine, the innovation premium, and the upside potential that comes from owning the companies building tomorrow's economy. 3 funds, 3 clear jobs, no overlap, no complexity. The question becomes allocation, and that depends entirely on your age, your temperament, and how much volatility you can genuinely hold through without making an emotional decision you will regret. If you are in your 20s or 30s, you have the most valuable resource in investing: time. Time means you can absorb more volatility because you have decades of future buying opportunities ahead of you. A reasonable starting allocation might be 50% in VOO, 20% in SCHD, and 30% in QQQ. You get solid, broad diversification, meaningful dividend income that compounds through reinvestment, and a significant growth tilt that can produce substantial wealth over a 30-plus year horizon. If you are in your 40s or approaching mid-career, the calculus shifts. A 60% VOO, 30% SCHD, 10% QQQ allocation still participates in growth while becoming more conservative and generating more income. The dividend stream from SCHD becomes increasingly meaningful as a percentage of your portfolio's total return. And if you are approaching retirement or already there, the allocation I would most seriously consider is 70% VOO and 30% SCHD, and I would think carefully about whether QQQ's volatility is appropriate at all. When you are living on your portfolio rather than contributing to it, a 40% drawdown in a portion of your holdings is not an abstract risk. It is a direct threat to your standard of living. These are not rigid rules. They are guideposts. The most important principle that cuts across every age and every allocation is this: own high-quality assets, keep your fees as low as possible, and remain invested for the long term, regardless of what the news cycle is telling you to do. Now let me show you the mathematics behind this approach, because this is where the magic happens, and where most people's understanding breaks down until it is too late. Compound interest is the most powerful force in personal finance, and most people do not fully appreciate it until they see the actual numbers laid out over realistic time horizons. Suppose you are 30 years old. You have managed to save $100,000 through hard work and disciplined spending, and you plan to retire at 65, giving you 35 years of compounding. You commit to adding $10,000 per year to your portfolio. That is approximately $833 per month, achievable if you treat it as a non-negotiable expense rather than what is left over after everything else. You invest those contributions into these 3 ETFs, earning an average of 9.5% per year, a conservative estimate modestly below the S&P 500's historical average. During retirement, your portfolio shifts more conservatively, earning approximately 7%. Here is what the mathematics produce. By age 65, your portfolio is worth approximately $6.6 million, starting from $100,000 with $10,000 per year in contributions over 35 years. That $6.6 million invested conservatively at 7% generates over $460,000 per year. If you need $100,000 to live on, you spend that and let the rest compound. Your portfolio continues growing through retirement. You will never run out of money. In fact, the wealth you leave to your heirs will be larger than what you retired with. Now let me show you the cost of the wrong choice, because I think this is the most important financial calculation most people never do. Suppose instead of buying low-cost ETFs, you invest with an advisor who places you in actively managed mutual funds charging 1 to 2% per year in annual fees. Because actively managed funds tend to underperform the index by approximately 1% per year, even before fees. Instead of earning 9.5%, you earn 7.5%. Instead of earning 7% in retirement, you earn 5%. Run the mathematics again. To achieve the same retirement income, you now need to save $19,000 per year instead of $10,000, almost double. And instead of retiring with $6.6 million, you retire with approximately $4 million. You have lost $2.6 million. Instead of your money lasting well past age 90 with a growing estate, you run out before age 83. Not because you made poor choices about what to invest in, not because you failed to work hard or save diligently, because you paid fees that compounded against you for 35 years while your fund managers collected their management fees, regardless of whether they delivered for you. This is why the fee question is not a minor detail. It is a question worth millions of dollars. And there is one more dimension worth understanding for investors who are willing to learn it, a strategy that requires education and discipline but can meaningfully accelerate these projections. It is called selling covered calls. If you own 100 shares of VOO, you can sell someone the right to purchase those shares from you at a specific price by a specific date. They pay you a premium for that right. If the stock rises above that price, they exercise the option, and you sell your shares at a profit while keeping the premium. If the stock stays below that price, the option expires worthless, and you keep both the premium and your shares. You have generated income from assets you already own, without selling anything, without taking on additional risk beyond what you already hold. Suppose you add 1.5% per year to your returns through this approach consistently over time. Return to our 30-year-old with $100,000 and $10,000 per year. Instead of 9.5%, they are now earning 11%. In retirement, instead of 7%, they are earning 9.5%. The difference in terminal wealth is not incremental. It is transformational. I am not saying every investor should rush into options trading tomorrow. This requires education, practice, discipline, and a clear understanding of the mechanics involved. But the tools exist. They are available to ordinary investors. And applied thoughtfully, they represent an additional layer of return that does not require taking on speculative risk. But let me tell you something that does not appear in any of these calculations and matters just as much as all of them combined. Discipline, patience, the ability to sit still when everyone around you is either panicking or celebrating. Investing is not hard because the mathematics are complicated. The mathematics are straightforward. Investing is hard because human psychology works directly against you. When markets crash and the news is saturated with predictions of catastrophe, every biological instinct you possess tells you to sell, to protect what you have left, to get out before things get worse. When markets are soaring and everyone around you appears to be getting rich effortlessly, every instinct tells you to buy more, to chase the returns, to make sure you are not left behind. Those instincts are wrong. They are precisely and reliably wrong. And they are why most people, despite living in the greatest wealth-building environment in human history, end up with mediocre investment outcomes that fail to reflect either the effort they put in or the returns that were available to them. The best investors I have known across nearly 9 decades share one quality that has nothing to do with intelligence or education. They can sit still. They can watch their portfolio drop 30% in a single year and not panic. They can watch a neighbor get rich on some speculative investment and not abandon their own rational plan to chase it. They have the temperament to remain committed to a sound process, even when it feels impossible. Charlie Munger, my partner for decades, used to say that the big money is not in buying and selling, but in waiting. He was right. We made most of our fortune at Berkshire, not by being brilliant traders, but by buying good businesses and sitting on our hands for decades. We bought Coca-Cola in 1988 and still own it. We bought American Express in the 1960s and still own it. The same principle applies to your 3 ETF portfolio. Buy them. Set up automatic contributions every month or every quarter. And then the most important instruction, leave them alone. Do not check your balance every day. Do not panic when markets drop. Do not get greedy when they soar. Keep buying consistently through every market environment and let time do the work. I have lived through more market crashes than I can count. The Kennedy slide in 1962. The bear market of 1973 to 1974, when stocks fell nearly 50%. Black Monday in 1987, when the market dropped 22% in a single day. The dot-com crash from 2000 to 2002. The financial crisis of 2008. The COVID crash of 2020. Every single one of those crashes was a buying opportunity. Every single one felt at the time like it might be the end. And every single one was followed by a recovery that rewarded those who stayed invested and punished those who sold in fear. There will be another recession. There will be another bear market. There will be another moment when the headlines tell you the world is ending and stocks will never recover. That moment will be your most important test as an investor. And the right answer will be the same as it has always been. Stay invested, keep buying, trust the process. My mentor, Benjamin Graham, taught me something I have carried for over 70 years. In the short run, the stock market is a voting machine. In the long run, it is a weighing machine. In the short run, prices are driven by emotion, fear, greed, momentum, speculation. Stocks move based on what people think, rather than what they are actually worth. But in the long run, prices reflect fundamentals, earnings, cash flow, the genuine value of the underlying business. That is why staying invested for the long term is not just one strategy among many. It is the foundational requirement that determines whether everything else works. When you buy VOO, SCHD, and QQQ, you are buying the best businesses in America. You are betting that over the next 20, 30, 40 years, these companies will continue to grow, innovate, generate profits, and create value for their shareholders. Based on the evidence of the past century of economic history, that is one of the safest bets available to any investor at any level of wealth or sophistication. The mathematics of compounding will do the rest. Your only job is to give them enough time to work. That is all. If this framework helped clarify something about how wealth is actually built over time, subscribe and share it with someone who needs to hear it. Every person who starts earlier stays invested longer and avoids the fee traps and behavioral mistakes we have discussed today ends up in a fundamentally better position through no magic, simply through the patient application of principles that have worked for a very long time and will continue to work. I will see you in the next one.